Well, we're back in action after a nice 3-day weekend. Hope we all enjoyed your President's Day. We actually got hit with a pretty big snowstorm, only our second one of the year here in the Mountain West. So I was out busy snow blowing and, of course, having a little bit of fun with my 3-year-old as well, building snowmen and doing some sledding. So I hope you had a chance to get out and enjoy your weather as well. Now, of course, with the market open again here today, we did have some interesting developments. In particular, I think the big news story was Walmart. So that's a topic I want to spend a little bit of time on during this video. And of course, check out how the rest of the market fared as well. So let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brendan Van Zee. It's February 20th, 2018. Glad to have each and every one of you on board here tonight, whether it's your first time watching or whether you're a longtime viewer of David and I's videos. Now keep in mind, if you are new to YouTube in general, we would invite you to subscribe to our YouTube channel by clicking that red button. You can also click that little bell icon that'll notify you anytime we upload these videos to YouTube. In addition to that, if you enjoy these videos, we would encourage you to click that thumbs up button every single day. That lets us know that you appreciate them and that you want us to continue to deliver this content for you going forward. In addition to that, you're welcome to make comments on these videos by scrolling down to the comments area and leaving a comment or question for us. And lastly, if you look in the description area there, you should be able to find a bunch of different links. One of them should allow you to sign up for our email distribution list, which generally reminds you of these videos once per day whenever they are available, and also gives you access to the stocks that are giving you bullish and bearish clusters if you're interested in that sort of thing as well. Now, in addition to YouTube, David and I are both heavy users of Twitter. Make sure you're following us. My handle is @BrandonVanZee, all one word. The Market Scholars handle is @market_scholar. So be careful there. I know sometimes people have a tendency to put those two words together, but we actually are market_scholars. And then follow David as well, who I believe his handle is @DavidSettle42. If you like these videos, David and I always put our link to these videos on Twitter, and we would encourage you to both like and retweet these videos. That way it helps us spread the word about these videos as we're trying to get a small business launched here. In addition to Twitter, we would invite you to sign up for our Facebook group. We now have nearly 900 people in that group, and it's a great experience. That way you can kind of ask questions of other people that might be a little bit more familiar with some of the tools that we use here and get a better familiarity with how we approach the markets. All right, with that, let's go ahead and check out what's going on here in the stock market. Now, as I mentioned here, today was a big day in terms of retail earnings. We had Home Depot that came out and fared reasonably well, but we also had Walmart. Now, of course, Walmart is the largest brick and mortar retailer on the planet. They probably do a tremendous amount of sales as well. Of course, Amazon from a market capitalization perspective is bigger than Walmart these days, but Walmart is still a very, very big player, nearly a $300 billion company in the stock market. And so when you see a day like this, it does have a lot of people asking questions. What happened exactly? You can see that I have Walmart pulled up in front of us right here. It was down over $10 per share, which I believe on a per share basis, that was its worst day in history. Now, on a percentage basis, being down 10%, they've probably had a few worse days than that, going all the way back to their founding. But nonetheless, it's a massive day. We're talking about billions of dollars of market capitalization lost here today. Now, of course, Walmart is a Dividend Aristocrat company. In fact, I should probably try to pull up my Twitter feed here. And by the way, for those of you that didn't catch my President's Day tweet there yesterday, make sure you check that out. My dividend investing Mount Rushmore per se is Johnson & Johnson, Coca-Cola, Procter & Gamble, and 3M. You'll notice Walmart's not on there. However, Walmart is a company I have a lot of respect for. They are a Dividend Aristocrat company. And if you give me just a second here, I haven't refreshed this yet today, so give me a moment. There we are. I will show you that Walmart not only reported their earnings today, but they also increased their dividend. We had a few different dividend increases. Remember to follow me on Twitter if you're interested in that sort of thing. Home Depot increased their dividend by 16% today, which was exceptional. That's a very good increase. Walmart, very poor, 2%. And then Genuine Parts, which is a Dividend Aristocrat company like Walmart, 6.7% increase. But I wanted to focus on Walmart here for a moment just because their stock was in the news so much today. This is something that those of you that have been following me over the years in my dividend growth investing classes should be very familiar with. And I wish I had better news to share with you because we've been waiting for quite some time for Walmart to kind of kick this pattern of raising their dividend only 2%. Now, for those of you that have been away for, let's say, 5 years or so, you might think of Walmart as a very generous dividend raising company. That used to be its MO. It used to be a double-digit percentage increaser year in and year out. And then all of a sudden, about 5 years or so ago, they started changing their ways. And they recognized that they were on the Dividend Aristocrat list, and they probably don't want to fall off of that. So at least they continue to raise that dividend, which I applaud them for. But the problem is they're kind of a dividend increase player that doesn't quite get up and over inflation. Remember, when a company increases its dividend, you want it to be more than inflation, and that way you as an investor are constantly seeing your buying power improve as time goes on. If a company is increasing its dividend but only doing it by, let's say, 1% and inflation is 2%, then you're actually seeing that your buying power is being eroded over time. So that is one of the challenges with Walmart. Yes, it is an elite dividend payer. It's on the Dividend Aristocrat list, meaning it's raised its dividends for more than 25 years in a row or more. But these 2% annual increases that we've seen here recently have been truly disappointing. Now, back on track with what happened with the stock today. Of course, it was the earnings really that did the damage to the stock today, not the disappointment in the dividend increase. A lot of folks will ask me, typically, because they know my interest in Dividend Aristocrats, what are your thoughts regarding Walmart? On a day like today when it's down 10%, is it a buy? After all, one of the mantras I preach for long-term investing is buying high-quality merchandise on the cheap, which is true. Now, the problem with it is this. Like a lot of stocks, Walmart has gone ballistic to the upside over the last couple of years. So I'm not overly enthusiastic about Walmart right here. What I do have a healthy amount of is respect for Walmart. When it comes to the two major retailers in the Aristocrat list, Walmart and Target, given the choice between buying Walmart with a 3% yield and Target with a 4% yield, I'd probably be more interested in Walmart with a 3% yield. Even though the dividend would be less, I just view the long-term path to prosperity a little bit easier for Walmart than it would be for Target when it comes to fighting Amazon. Amazon is the big, 800-pound gorilla in the room. They're disrupting industry after industry after industry, and of course, they are Walmart's biggest foe as well. And so where we stand today with Walmart, yes, we had a major hit today. Would I be upset about it as a potential shareholder? No, I wouldn't. The reason for that is this. If you're buying Walmart for the long term, like we did in our Dividend Aristocrat classes that I've taught in the past, so some of you, in fact, a handful of you I know for sure, are owners of Walmart, and that's great because you bought it at the right time. You'll notice that I have pulled up here my dividend stair-step chart, and where we first bought Walmart in my dividend classes was right back here. Now, you might recognize this date as I point at it. It's actually August 24th, or the week of August 24th, 2015. These are weekly candles here. That, to spur your memory along a little bit, was when we had that mini flash crash, late August 2015. It was at that time where we had our first opportunity to buy Walmart with a 3% yield. My class did so. We were waiting in the wings, waiting for that moment to purchase it. Now, you will notice after buying that stock with a 3% yield, it ended up going down quite a bit more, just as a reminder that we don't know where the bottom is. What I'm hoping to accomplish as a long-term investor is a reasonable level of value. I know I'm not going to get it perfect every single time. But it was interesting in Walmart's case because I remember I was teaching a workshop in Chicago in December of 2015, and I remember somebody was giving me the business on stage. You know how people try to rile up the presenters, and somebody was really aggravated by the fact that Walmart had continued to go down even after having a 3% yield a few months earlier. Now today that's of course laughable because at the height of that anger from the shareholder base, that was basically the bottom of that stock. At that time in December of 2015, that was about a $59, $60 stock. And even after accounting for the massive decline in value today, you're talking about a stock that's gone from 60 bucks up to 94 where we're at right now. This chart puts it in perspective. This is a 10-year chart. So you can see this is not normal what Walmart just went through in the prior year. Yeah, today wasn't normal either. You don't expect a company like Walmart to lose 10% of its value in one session. But let's not forget the conditions that were caused in order to get to this moment in time, which was a stock that just ripped higher. In fact, you could have bought Walmart with a 3% yield in January of 2017. Now, we were buying it way back here, but you know, the Johnny-come-latelys could have still had an opportunity with a 3% yield in January of 2017. That was not that long ago, just over a year ago. So we're talking about a company that went, in this case, from about 65, 66 bucks up to about 110. That is not normal. We're talking about a $300 billion company here at today's prices. So I take these types of moves, like we see here today, in stride as a long-term investor. It doesn't bother me to know that a stock is down 10% if we're talking about a company that just went up 80% in value in the year before. A lot of that value that it increased last year was probably not deserved, and therefore giving some of that back as a long-term investor is perfectly acceptable to me as well. Not everybody will see it that way, and that is perfectly understandable. Obviously, we all approach the markets in different ways. What I challenge you to do is find out who you are as an investor or a trader, and try to hone in on whatever strategy that might be. But from a technical perspective right now, obviously a lot of loss of momentum. From a value perspective, I don't think we're even anywhere remotely close from a dividend perspective where it would be interesting for a new buy yet. Maybe there's another reason from a valuation perspective where you could talk yourself into getting into it. But as a dividend investor, this thing has a long ways to go to get down here to this 3% stair step yet again. So thank you for allowing me to have that opportunity to speak about Walmart, since that was the story of the day in the stock market today, and so many of you know that I do follow these dividend aristocrats very, very closely. So with that, let's get back on track now with what's happening in the rest of the stock market, which of course Walmart being one of the major players in the stock market does affect things. Now, you'll notice here with the S&P 500, we were down today about 16 points. That was good for about a 0.6% pullback. Pretty decent pullback there. You'll notice that the color background chart is still green, meaning we still have a bullish intermediate term posture according to the market forecast tool. But if I go to my next chart, I want to kind of point something out. Notice we have green across the board with these four charts as well. Remember, these are your four major indices here in the United States, the S&P 500, we got the Dow Jones, we got the NASDAQ, and we got the Russell 2000. But what I wanted to point out, which I find interesting, and we'll have to see where it goes, is with today's bounce down, a lot of the candles look bearish. Remember, the posture is still bullish. One day does not make a trend. We need a lot more damage to the charts before we flip back to another posture again. But I will say that from just a candlestick analysis perspective, today doesn't really light the world on fire if you're a bull. Notice that in the case of the S&P 500, the case of the Dow Jones, and the case of the Russell 2000, we basically went right up to that 30-day moving average, kissed it, and bounced lower. We don't really like to see that. And you guys might be wondering why David and I use the 30-day moving average so much. After all, you probably hear on CNBC or Bloomberg much more talk about the 50-day moving average or the 200-day moving average. And there's nothing wrong with those either. If you follow those, great. The more information, the better in most cases. But you will notice that in many cases, the 30-day moving average can act as support or resistance. And so in this case, that does worry me a little bit about the near term. of the market, meaning that we just had a heck of a rally last week, right? In some cases, it was the best 1 week performance for the stock market in several years. Now, that needs to be taken in context because the week before was so bloody, so it was kind of a dead cat bounce there, but we have to be careful here because a lot of these different charts are showing us going right up to where you would anticipate some resistance coming in and a possible bounce down starting today. How long that lasts is anybody's guess, but we just have to be wary of that. We don't want to go full bore bullish here all of the sudden and think the coast is clear, because we might have some more chop and slop in front of us before we determine which direction this market needs to go. Moving on now to our next chart here, let's take a quick peek at our chart that describes the 3 green arrow status of the market right now. You'll notice that only the NASDAQ retains its 3 green arrow status. The other charts are white, meaning that we have a mix of green and red arrows on the 3 different indicators that we're looking at for this, which include the 30-day moving average, the MACD, and the stochastics. So if we hone in on the NASDAQ here, you will notice that we have this green arrow that kicked into place because the index rose above that 30-day moving average 3 sessions ago and continues to be there, but look at it's just by the slimmest of margins right now. So be aware that as soon as tomorrow, this chart could easily turn white because we might not have 3 green arrows anymore. If this were to close below the moving average line, then you're going to have at least 1 red arrow on the chart. But we do still have a green arrow with the MACD showing us some strong momentum, and we can see that the bulls have the ball because we still have stochastics with a nice green arrow as well. All right, moving right along now to our next chart. Let's take a look at a longer term view now. This is our 1040 crossover method. Now in this chart, we're not looking at daily candles like we have up until this point on these other index charts. This particular chart setup is going to show us weekly candles, and it's showing us the 10-period moving average, which is represented by the gold line, and the 40-period moving average, which is represented by the black line. What we're looking for are crossovers of those moving averages. This is a ultra long-term approach where you're really just looking to capture the majority of the trend, understanding you're not going to get out at the top, you're not going to get in at the bottom, but you want to participate for the length of that kind of 80% in the middle of that trend. Now be aware, you can have head fakes and chop and slop on this style as well. As we saw back here, we went from green to red to green to red. But ever since basically the spring of 2016, which we're basically knocking on the door of a 2-year anniversary at this point, we have had a bullish posture across the board with the 4 different major indices here in the United States. So had you been using this as your guide for, let's say, investing your 401k mutual fund money, you should be reasonably pleased that you've been able to take advantage of these strong winds that are going in the favor of the bulls here over the long haul. Now, as mentioned previously, the Russell 2000 is going to be the one that we're looking at the closest, because if there's going to be one that does cross first bearishly when this gold line crosses below this black line, it's likely going to be the Russell 2000 as it stands right now. We've just seen a little bit more stress, a little bit more bearishness in that index than we've had in the others. But even that, I wouldn't say is anything that we have to concern ourselves with right now. It might take another few weeks, possibly a few months, but this moment in time, we're not seeing anything quite close to a crossover here yet. All right, let's go ahead and now spend a little bit of time on the sectors. Now on these sector 12 grids, since it does fill up my entire chart here, I do have to kill that camera feed so that way you guys can see all 12 of them. So let's do a little bit of analysis here. As you can see, the S&P 500 is a chart in the upper left. The other 11 charts that come after that are your 11 different sectors that make up the S&P 500. You will probably be directing your visual attention to the second chart on the top. That is energy, and the reason you're looking at that is because it's got a pink background, and what that basically lets you know is that we have a bearish posture using the market forecast intermediate/green line. And so that's the only one that we have a concern with posture-wise right now. But again, I will point out that because the S&P 500 itself went up to that moving average, kissed it, and now bounced down, we want to keep our eye on that. Now, obviously, if we have a huge update tomorrow, that reverses that immediately. But if that ultimately becomes a resistance area for the market, then we got to see how are the other sectors handling that as well. And so as we take a look at some of these different sectors, notice, for instance, in the industrials right up here in the upper right. It also went up to that moving average, kissed it, and bounced down. It almost looks like it's in lockstep with the S&P 500. So just pay attention to those. Yes, we have a bullish posture right now on something like the industrials, but I wouldn't rule it out at all to say that being moderately bullish is best case scenario right here after that huge rally that we had. And for those of you that want to kind of jump the gun and be moderately bearish, I don't think I'd hold it against you. Make sure you're following your rules, obviously, but you know, if some of you are selling some bear call spreads up at these levels, I don't think that's the worst idea on planet Earth either, after we've had such a big rally where prices are much more extended to the upside after this past week that we've had. All right, let's go ahead and take a quick peek here now. Oh, and by the way, our trade idea is going to come from the healthcare sector today, so pay attention to the fact that the healthcare chart is green down below. All right, let's take a look here at our next 12 grid, which would be the foreign markets 12 grid. Here, you probably are directing your attention to India. And India looked pretty good about a week ago. So it just goes to show you how quickly some of these things can unwind. We had this nice move up in India, and then we quick little reversal back. Now, I have high hopes for India over the long term. It's one of those markets that is somewhat difficult for US-based investors to access. I think they have a tremendous amount of potential growth in front of them in the decades to come. But, you know, think of them almost like the way that you would think of a tech stock versus a utility stock. You probably anticipate tech stocks will go up on the whole a lot more than utility stocks over the long haul, the way that I would expect India to go up a lot more than, let's say, the United States in many decades from now, because their growth from an economic perspective, from a population perspective, suggests as such. But you're also going to have much more volatility along the way. So you kind of have to know what you're signing up for when you're getting into some of those more robust growth markets that are out there, like your BRIC companies, Brazil, Russia, India, and China. Right now, India is the one that's showing us some bearish conditions according to the green line on the market forecast, but a lot of the other markets look reasonably healthy. You'll notice that some of them are kind of starting to roll over a little bit like the S&P 500, but you'll notice that these charts don't look quite as similar to the S&P 500 as the sector charts, and that makes sense. A lot of people try to go towards foreign markets for the diversification that they supply, but the lack of correlation in some cases as well just kind of helps offset some risk in some areas. You'll notice that a couple of the charts that continue to look reasonably good, Brazil, I would say, looks pretty solid. You know, it still had an up day today, 0.7% to the upside, rising above that upward trending moving average. In addition to Brazil, the other one is South Africa. Now, South Africa, got to be a little careful on that one, because it's possible this is a double top that's forming here. We'll just have to see how it plays out. We're right back to kind of that level where if you were looking for a pullback to a moving average, maybe you could play the bounce here if one does eventually develop here. But a lot of these other charts do show us similar action to the S&P 500, not to the point where you're kissing the moving average. Like if we use United Kingdom as one example down below here, United Kingdom went up, but notice it didn't come all the way up and touch its moving average. It fell short and is now rolling over like some of these other markets. All right, let's take a peek now at our Intermarket Analysis 12 grid. Now, I've had a lot of people ask me, hey, how do I get these charts? Now, I understand that the tutorial that I used to have with my old employer no longer exists. And so what my plan is to do another tutorial once David and I launch our services, and all of you that are market scholars, clients will have access to those. So we do appreciate your patience along the way, but I'll do my best to crack out another tutorial for you at some point down the road when we have a little bit more time after the dust settles a little bit. Back on track here with the analysis, you can see with the intermarket analysis, it's a mixed bag. We have a lot of pink, we have a lot of green, meaning that we have some bullish, some bearish. One thing I will point out is that volatility did rise today. Remember, I think it was the Dow that broke its 6-day winning streak here today with a downside move in the Dow. Well, it makes sense then, of course, volatility was up. And you'll notice that volatility, after popping so high here a few weeks back, it pulled all the way back touched that moving average, is now bouncing off of it. So we'll see if that represents a launching pad for volatility to the upside. If that's the case, you'll probably find that those 30-day moving averages might represent a launch pad to the downside for the broad market. So we'll have to keep our eye on that developing story as well. As far as things that are trending reasonably well, you know, Treasury yields are, of course, the talk of the town this year. And we did have Treasury yields rise yet again today, taking a hit to some of those more interest rate sensitive areas of the market. In fact, let's go over here to the Market Watch tab. Let me take a look here at our sectors. And if I sort by mark percentage change, you can see we had one sector in the plus today, and that was technology. I know the semiconductors were looking reasonably good. I know Qualcomm was out there raising its bid for NXPI semiconductors at the same time that Broadcom wants to buy out Qualcomm. So kind of a interesting love triangle there. You can see on the downside we had the staples. Now, of course, big reason for that, Walmart. You know, Walmart is one of the biggest. In fact, I'd have to think about it. It might very well be the biggest consumer staples. Let me just check on that before I give you the wrong information. Yeah, Walmart is the biggest consumer staples company by a long shot, $278 billion as opposed to Procter & Gamble at $205 billion. And so when you have the largest component of a sector take a hit the way that Walmart did today, it's going to put even greater force upon that sector than a smaller player would. So a big portion of this 2% pullback in the staples at large today were likely due to Walmart. But you will notice that we had the XLU and XLRE as two out of our bottom four. Now remember, those two are very interest rate sensitive. So when we're looking at something like the Treasury yields going higher and higher and higher, seems like endlessly here recently, then those other areas of the market like utilities and REITs will really struggle in that environment. All right, so let's go ahead and do a trade application example here today. I'm going to pull up just a regular market forecast chart here, and I'm going to pull up ticker symbol ABC. Always an interesting one there, used for example purposes in many cases, but we have to remember ABC is an actual ticker symbol. So really a better way to show an example of a fictitious company would be to say XYZ, since that ticker symbol does not exist. But having said that, it's entirely possible a year from now, ABC's ticker symbol will no longer exist. For those of you that follow the market news closely, you'll know that they had a nice little pop higher here a week or so ago on the news that Walgreens, another Dividend Aristocrat company, was exploring the possibility of buying out the portion of AmerisourceBergen that they don't currently own. And so that helps support the stock. You'll notice that after a little bit of a pullback the next day, we then had some nice consolidation towards the upside, and now we are above a rising moving average here. You can see that the market forecast green line pointing nicely higher here as well. Now, in a case like this, you have to set your expectations properly as well. If a bid is already theoretically out there from a player, you probably don't want to look at this company from a trending perspective, thinking that, hey, I'm going to buy it here at 99 and at some point 2 years down the road, I'm going to sell it for $200. That's likely not going to happen. Could a competing offer come in from CVS or some other healthcare-oriented company? Sure, that's entirely possible. But the reality is, you know, you're probably not going to see strong trends from this moment going forward. And so what I thought we would do today is something that is not something like buy a long call to take advantage of a huge upward move. We're going to do something much more moderate, something much more moderately bullish, particularly in light of the fact that despite the market still having their bullish postures intact, they're a little precarious at best, bouncing off of those moving averages. So I want to stay a bit more conservative on today's trade application. So what we're going to do with ABC, let's go out to the March contracts, the normal monthly contracts with 24 days till expiration. Now, one thing I did notice, not a lot of options traders in these names, but you will notice there's one option contract that does have a lot of volume. Hopefully that means a lot of liquidity as well. And that is your contract that I'm pointing at right here. It has 2,592 contracts in it. And that is your $100 strike. Nice round number. In fact, it's almost perfectly where we closed today. We closed at 99.94. So what we're going to do today is what's known as a buy right. We're basically going to buy 100 shares of this stock. Now that's going to cost you 10,000 bucks since this is a $100 stock approximately. But at the exact same time, we're going to sell a call against it. Now normally we're selling an out of the money call when we're doing covered calls. This one we're actually going to do an at the money call. Remember, that is going to have your most extrinsic value in it. And the reason we're doing that is because we don't expect a huge move going forward unless you are somebody that believes we've got a white knight waiting in the wings that's going to raise the bid even further than what Walgreens might offer ABC. So today's trade example, fairly simple. We're just going to right click on that contract. You can right click on either the bid or the ask. It doesn't really matter. And then go to buy. So this is a little bit tricky. Some of you might think, okay, well, we're selling a covered call. We got to sell that, right? Well, the way that the Thinkorswim platform handles this particular trade, since we don't already own the shares in our account, we'd have to buy them. In addition to selling a call against it, we actually call this a buy right. Now, if you already happen to own ABC just randomly, you might still consider just selling a call all by itself against this as well. But in our case, since we don't own it yet, we're going to do what's known as a buy right. So we're going to go up here to buy, and then choose this option right here, covered stock. That loads up our trade down below, and you'll notice one line says plus 100 ABC common stock, and the other line says -1 of the March monthly contract's $100 strike price. You'll notice that our debit for that is $97.04. So what's happening here is it's basically taking the amount that it is right now. Let's just, to make the math easy, say this is a $100 stock. It's 6 cents away from that. So it's a $100 stock. So you might be asking, well, how come I'm getting it for $97? The reason is they're taking this premium that you're selling and applying that to your order for all intents and purposes. Now remember, you have to get rid of this if it closes above $100 on your expiration day. So really what we're trying to do here is we're trying to say we want to make a quick 300 bucks. We're trying to buy this for a net price of 97 right now, and we're willing to sell it for 100 24 days for right now. Now remember, there's risk in this too. Walgreens could come out and say, we're no longer interested, or the Justice Department could come out and say, we're not going to let you do the deal. So remember, this is not a free money situation. There hardly ever is that situation. But I think it's reasonable to expect this deal, at least in the next 24 days, to stay on course. And if this stock closes above 100, then you're going to have an opportunity to make close to $300 on this trade. Of course, you have to factor in commissions and all that as well. Some of you might say, well, why don't you just do the selling of the put at 100? You could do that as well. Reason I'm doing the buy right in this particular case is you'll notice the open interest on the put side is a lot worse, only 125 contracts. So the call side's a little bit more liquid here. Let's go ahead and make that our trade application example for the day. So confirm and send. We're spending that $9,700 on this. We'll ship that off. All right, so thank you so much for checking out these market outlook videos once again, and it's always a pleasure to get a chance to work with you. I'll be back with you on Thursday. David will be with you tomorrow. Best of success with your trades and your investments, and we'll look forward to working with you going forward. Take care, everybody. Good night.